Good morning and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, looks like we are poised for a third straight day of gains. Yesterday, although it was a very volatile session, we came off significantly from the day's high. But the good news is that the Nifty managed to defend that 23,200 mark. 23,263, that's the November low. The important factor will be to sustain above those levels. And this morning, the GIFT Nifty is hinting at a positive start. Once again, of course, there is good news in terms of the US CPI data that came in last night. Core CPI has cooled off, come in below expectations. Perhaps that is why we saw a very strong rally play out on Wall Street. Asian markets also upbeat in the wake of that, and we are also poised for a good start. Lots of stocks in focus, but it's an earnings heavy day, a busy day on the earnings calendar. We have big boy Reliance Industries reporting numbers. You have Infosys from the IT pack, which will be reporting numbers. All eyes will be on guidance, and Axis Bank. That will also be reporting numbers. Of course, the stock is under pressure ahead of earnings. But yes, all your stock related queries, how can we forget that? Keep them coming in. We'll get them addressed by our experts. And before we, get started with the show, let's quickly take a look at the top headlines at this hour. Stocks surge on Wall Street as CPI inflation for December comes in lower than expected. Nasdaq gains nearly 2.5%, snapping a 5-day losing streak, while the S&P 500 posts its best day since November. Even the 10-year yield, which has been on an upward trajectory, pulls back from a 14-month high. Asian markets surge on strong Wall Street cues. In a surprise move, Bank of Korea has left interest rates unchanged versus expectations of a cut. The GIFT Nifty, on the other hand, is suggesting a gap-up start for the Indian market. Crude prices continue to move higher, with Brent hitting $82 a barrel, driven by lower US inventory and the fallout of new sanctions on Russian oil. Meanwhile, gold gains as a softer than expected US CPI boosts hopes of the Fed easing rates. Among key earnings to watch, big boy Reliance Industries is expected to deliver margin expansion when it reports third quarter numbers after market hours today. For Infosys, all eyes will be on a possible revision in guidance. Also watch out for earnings from Axis Bank and LTI Mindtree later today. And Israel and Hamas reach a ceasefire agreement to pause the war in Gaza after 15 months of fighting. The deal will come into effect from Sunday, with the first batch of 33 hostages set to be released by Hamas in exchange for the Palestinians held in Israeli jails. Israeli Prime Minister Benjamin Netanyahu says final details of the deal are still being worked on. All right, we're just about 5 minutes away from the market open, but let's quickly take a look at the setup then. Yesterday we ended in the green. For a second day on the trot, but it was a fairly volatile session. In fact, we did slip into the red a couple of times during the course of the day yesterday. In fact, we held on, but still we managed to hold on above that 23,200 mark. Mid-cap index was also off highs, but, we saw relative outperformance coming in there in terms of, Nifty gainers. You had Trent, on the back of positive, brokerage notes from Elara. We saw a good rally coming in on Trent. In fact, that stock, snapped out of an 8-day losing streak yesterday. Power stocks saw, buying action on expectations of higher budget outlay as well. And there was a brokerage report on Maruti, which pushed up the stock by 2%. Also, BSC, that stock has been on a gaining spree. Yesterday as well, a 6% up move on the back of, initiation by Nuvama with a buy rating. In terms of the put call ratio, the Nifty PCR fell to 0.82 vis-a-vis 0.86, and if you look at the Nifty ban list, FNO ban list rather, you have some new entrants this morning. Aditya Birla Fashion, Kalyan Jewellers, that has seen quite a bit of a sell-off, since the start of the year, and Manappuram Finance as well. But there are certain stocks that will continue to be in FNO ban. Those are the likes of Aarti Industries, Angel One, Bandhan Bank, Hindustan Copper, L&T Finance, RBL Bank. And in terms of fund flows, FIIs continue to be sellers. They have been selling consistently since the start of the year, and 4,500 crore worth of selling coming in the cash market. But DI buying support continues, and we saw buying to the tune of 3,600 crore rupees in the cash market. But on that note, To understand the setup for today and the rest of the week, one more trading session to go after today, we are joined by Chandan Taparia, who's the Senior Vice President, Head Derivatives and Technical Research at Motilal Oswal. Great to have you on the show, Chandan. We've seen third straight, in fact, we are expected to see a third straight day of gains. But sentimentally, would you say we are still weak? 23,263, that's the November low. Do you think we can sustain above those levels, to end the week?
Good morning, Nandita. Thanks for having me. So we have witnessed some recovery from the lower levels, but the concern is follow-up is missing in the market. The good part is that index drifted to 23,050, but at the same time finding hurdle to surpass a key barrier of 23,333. We have seen a decent recovery in the bank nifty, but again the follow-up is missing. So we are in a range where supports are intact, but major trend is slightly negative, so pressure is being visible. So I believe 23,333 could act as a hurdle. Until it remains below the same, we believe it can retest to 23,000 and even 22,800 marks. So 23,333 is going to be a decisive level for Nifty index now.
All right, lack of follow-up, buying is something that is pressuring the market. But what would you do with FMCG stocks now? Renewed selling pressure. The stocks had, or the sector had started witnessing some buying support coming in since last week. But yesterday we saw the FMCG pack come under selling pressure. What would you do with some of these stocks like HUL, Marico, Dabur? Any thoughts there?
So Nifty FMCG index is finding sustained selling pressure. In fact, on the weekly chart, it is now in the words of giving the breakdown from a bearish pole and flag pattern, which has bearish implication. It tried 2-3 times to witness some recovery, but every time bounce is being sold. And the index is itself finding hurdle at its 50-day exponential moving average. So Nifty FMCG index looks weak as of now. We believe weakness could continue. Now looking at the stock specific, HUL failed to surpass a key hurdle, failed to surpass 50-day mark. We have seen call writing activity. So till it remains below 2430 zone, it can go down to 23,000. Looking at Marico as well, here we witness some recovery. Range bound bias could be there. But apart from that, counter like Godrej consumer product could be under pressure. Even the stock like Britannia is also finding some pressure. So Marico might be a resilience, but most of the other stocks are likely to be under pressure, or upside could be kept due to the changing structure and the trend of this entire sector.
Okay, that's the view then on FMCG stocks, but we just have a few seconds to go for the market to open. Let's take stock of what's happening in the pre-open. A good triple digit up move on the index, at least in the pre-open. So we are at somewhere around 23,380, just about to get the first ticks. There goes the opening bell. So yes, started the day with a good triple digit up move, 120 point uptick on the Nifty. We are above that 23,300 mark as well, cleared that crucial level. Sensex a good almost 500 point up move, and strength in the broad end of the market continues. We've seen quite a bit of a drubbing in the broad end of the markets since last Monday. Yesterday and day before, some bit of semblance of normalcy, but today good traction, 1.5% gain on the Nifty mid cap index. The bank index is also fairly upbeat. It's a 440 point up move on the Nifty bank index. We are above that 49,200 mark as we speak. But taking stock of some of the other sectors and what they are doing at the current juncture, I want to see what's taking the lead really. Because we have quite a few earnings to watch out for. So ahead of Axis Bank numbers, the Nifty Bank is showing strength. Autos, another 0.4% kind of an uptick there. FMCG is extremely flat. IT is up over 1%. Metals are up in excess of 1.5%. So yes, some of these sectors are taking the lead. But I just want to see what the FMCG pack is doing. It was showing extremely flat at the current juncture. Trading with a negative bias. Let's see how things really pan out. We just had Chandan's view on some of these FMCG names. In terms of individual movers, want to see what Reliance Industries is doing ahead of the numbers. Yesterday it was showing strength. It was up somewhere around 1% or so. Today Reliance Industries, it's kind of, it is in the green, extending gains, although the gains are fairly mild. But what's taking the lead really is HDFC Life. 8% uptick. Profit has managed to beat expectations. Premium growth has been in double digits, although VNB margins, value of new business margins, have seen some bit of contraction on a YY basis, but the numbers have been fairly good. Even the street view is pretty positive. We'll take you through that in just a bit. But Adani group of stocks, they are also in focus. Look at Adani Twins, Adani Enterprises up 5.5%, Adani Ports up almost 4%, and I'm sure the other Adani group stocks, will be reacting positively to news flow that Hindenburg will be shutting its operations. Sentimental positive for the Adani group. Because the short sellers damning report on Adani had triggered a massive sell-off in Adani group stocks, and we all knew how that really panned out. But Hindenburg's shutting shop, that has come as a sentimental positive news for Adani group stocks, which is why they are active in trade. SBI Life also rub-off effect from HDFC Life numbers. SBI Life reports numbers tomorrow. Tech Mahindra, Bharat Electronics, SBI is among gainers today. Ultratech Cement, Shriram Finance and IndusInd Bank, these are some of the other gainers. On the flip side, FMCG names continue to be under pressure. HUL is the top laggard. Even Pharma, for that matter, is under pressure today. If you look at Cipla, Dr. Reddy's, Sun Pharma, most of these pharma names are under pressure, and from the FMCG basket as well, not just HUL, you also have Tata Consumer, Britannia, Nestle, ITC, all of them are under pressure. And Trent, which saw a good recovery yesterday, has once again succumbed to selling pressure. Today it's the top Nifty loser as we speak. All in all, it's a good start, Chandan. A 130 point up move on the index. Whether or not we see a follow through, as we go, as we progress through the day, is a big question really. But in terms of stock recommendations, looking at the texture of the market, what would you be recommending?
So yes, looking at the market setup, I'm looking for Nifty to hold beyond 23,333 to change the recent negative structure of the market. Looking at the stock specific, I'll focus on SBI Life with the view that stock has bottomed out and forming higher top, higher bottom from last 3 weeks. Major support has changed, and most of the stocks from this sector are doing well. It has surpassed its key moving averages. So SBI Life could be one name. With support of 1495, it can head towards at least 1620 kind of level. Apart from SBI Life, we have positivity on the BSE, recommending this counter from last couple of days. Major trend is positive. The stock is up by more than 15% in this week and heading towards the new lifetime high territory. We are positive on the entire capital market theme. So BSE could be other name with support of 5800. It can head towards 6100 zone. So SBI Life and Bombay Stock Exchange will be two preferred idea in the morning tick. And hold of 23,333 Nifty could give some short covering trigger for further rally of 500 to 700 points in next coming days.
All right, SBI Life, one of your recommendations. But what about HDFC Life? Particularly for this particular chart, if you look at the last 3 months, the stock has been under pressure. 6 months as well, the returns have been negative. But today's move, does that signal a trend reversal? Numbers have been good, and the stock is clearly reacting, but it's still a long time away from its 52-week highs, which is at 761. Could there be a possibility of the stock making a dash or making a go for that level?
So after a long time, we have seen some buying interest in this counter. In 2024, it made high near 761. In 2021, the same sort of hurdle were being placed at 775. So most of the last couple of months were negative. However, good part is in the last couple of days, the stock has recovered entire decline of the previous month of the December. So expecting some recovery, beaten down name, formed a bullish setup. But only concern is already rated by 9%, use any small decline. As of now, 630 is immediate support, and hold of 630 can take it towards 675 to 700 zone.
All right, that's the view on an HDFC Life, but I want to quickly take our viewers through what to expect from Reliance Industries this time around. The stock is fairly active, in fact, fairly buoyant ahead of numbers yesterday as well. it was up 1% or so. In fact, the brokerages have turned bullish on the stock, and they are expecting an upside of over 35% on the stock going forward. But quickly taking you through the estimate then, profit is expected to grow 6% on a quarter-on-quarter basis, and margin expansion is also expected. Strong growth in telecom earnings is expected, as ARPUs, or average revenue per user, is expected to rise on the back of the tariff hike that telecom players took. There is a residual impact that will be seen in the third quarter. There is expectation that refining margins will improve, and that will aid the third quarter numbers. Third quarter revenue is also expected to rise on a quarter-on-quarter basis. EBITDA is likely to grow 5% sequentially. EBITDA margin is seen in the range of 18.2 to 18.9%. The O2C business is also expected to improve on recovery in diesel cracks and reduced crude premiums. These are some of the factors that will drive a sequential improvement in the O2C business as well. GRMs, gross refining margins, are seen in the range of $8.7 to $10.8 per barrel range. Petchem margins are, however, likely to remain under pressure. But for Geo in particular, EBITDA is likely to jump 4% on a quarter-on-quarter basis, as I mentioned, on the improvement in average revenue per user, which could rise to 203 to 205 rupees during the due to the tariff hikes that were undertaken. Retail expected to show growth. EBITDA likely to be up by 5 to 6% on a quarter-on-quarter basis on the back of higher footfalls, and there has been some recovery in urban consumption, and that's expected to aid retail EBITDA as well. The key to watch: net debt reduction on the group level, update on Geo listing timeline, if at all they come out with that. So that's about Reliance Industries. Let's get a chart check as well with Chandan. Chandan, the stock has been underperforming, but Street has kept the faith. Some of the brokerages are expecting upsides of over 35% on the stock. Recent times we've seen the stock holding on, but in the near term, where do you expect the stock to head?
So looking at Reliance Industry, stock had seen a corrective move in last 6 months from 1600 to 1200 levels, but from last almost 6 to 7 weeks, it has been consolidating in a range with higher base. It made bottom at 1200, and higher bottoms were being placed at 1206 and 1215 zone. So it did all the right way to get the stability, but follow-up is required. As of now, the immediate hurdle is near 1270, 1275. About 1275, it may complete a cup and handle pattern, which is bullish implication. So I'm waiting for those levels to surpass to get a conditional trade in the counter. So I believe 1270, 1275 zone could provide a buying interest for a target towards 1325. So it may see recovery, but require these levels to surpass, but getting some early sense of the bottoming out approach of the counter.
Okay, that's the view on Reliance Industries. Just a quick disclaimer: Money Control is a Network 18 owned company. So any advice on Reliance, you need to consult with your financial advisor. We are not giving any buy or sell recommendation on the stock. But moving on, let's shift focus to some of the queries that are trickling in this morning. Banks, of course, will be in focus as Axis Bank reports numbers post market hours. But SBI, that's one query that I can spot. A couple of queries, in fact. Utsav Jain wants to know your thoughts whether this is a good time to enter the stock for a 2 to 3 month perspective. And we also have Pooja Khanna, who wants to know whether it's a good time to add SBI. The stock, in tandem with the PSU banking lot, has been under selling pressure. Last 1 month we've seen 10% being shaved off, but off late the stock has seen some bit of action. Yesterday the stock was up. Today as well, it is among the top few Nifty gainers, 2.5% up move here. 770 is where it's at. Do you think the risk reward after the recent correction is looking attractive to enter the stock?
Yes. So now the risk reward ratio favors the counter, and we have noticed that earlier also it took support near 720, 130. This time also the same level were supported the counter. So I believe, looking at the current structure, it can head towards 800, 805 marks.
All right, I think there is that's the view on SBI, but there is some bit of a video glitch that has come in Chandan's feed. We'll try and fix that up. But in the meantime, let's take a look at what to expect from the third quarter numbers of Infosys. Now, analysts are expecting a revision in the FY25 revenue guidance. Nuvama sees the guidance at 4.25 to 4.75% in constant currency terms, while Kotak Institutional expects FY25 guidance to be revised, to 4.5 to 4.75% vis-a-vis the current 3.75 to 4.5%. Mind you, HCL Tech also revised, its guidance, but they narrowed the guidance. They didn't tinker with the upper band of the guidance, which came as a big disappointment for the street. And the stock, of course, got punished. So any disappointment, given the fact that IT stocks have seen quite a bit of a run up, any slight disappointment is also causing knee-jerk reactions on stocks. So yes, guidance will be the main factor to watch out for when it comes to Infosys. Look at some of the other factors that may weigh on Infosys numbers. These are, seasonality factor, of course, higher furloughs. Absence of large deals could also weigh on the third quarter numbers. Now, Q3 revenue is seen growing 0.5%, on a quarter-on-quarter basis. That's according to the Moneycontrol poll, and the profit is expected to grow 3.5%. On a sequential basis. Now, margin guidance is likely to be kept unchanged at 20 to 22%. Deal TCV is seen at around $3 billion for the third quarter. Key to watch will be, outlook on discretionary spending in BFSI and retail vertical. Both the other giants that have reported numbers, HCL Tech and TCS, have pointed to green shoots when it comes to discretionary demand. So yes, a commentary from Infosys also becomes crucial in that sense. Of course, updates on attrition and hiring plans are some of the other things that will be watched out for. Remember, the company had deferred its annual wage hikes to the fourth quarter. So yes, Infosys, crucial to watch out for. Even in terms of Axis Bank, let's take a look at what one can expect. Okay, I think we've got Chandan back. Chandan, Infosys numbers today. Stocks have done fairly well, but off late post HCL Tech numbers, we have seen some bit of selling pressure coming in, but particularly for Infosys, your thoughts?
Yeah, so HCL Tech witnessed some selling pressure post the result, but I believe Infosys could find some support. If I look at the monthly chart, the stock is finding some early zone of the breakout. In fact, on the daily chart, holding well to its rising support trend line. So I believe that 1920 is immediate support till it holds 1920. This time Infosys can surpass the previous lifetime high of 2006 and moving beyond that. So breakout could be seen, however, requires some call unwinding in 2000 and higher strike to get the conviction buy. But as of now, need to follow the support near 1915, 1920 zone for any kind of setup in the counter.
Okay, that's the view on Infosys. Let's shift focus to other queries then. Let's take up a query on Indus Tower. Nitin Shaji wants to know your thoughts. Looking at the charts, I haven't really opened it yet, but Indus Tower, if you look at the stock right now, it's up somewhere around 1% or so. Last 5 days, we've seen very good traction in the stock as well. Although for today, it has come off its opening highs. But would you ride the recent leg of rally on this particular counter?
Yeah, Nandita, the stock has recently bottomed out at 315 marks and witnessed a recovery till 363. However, it witnessed some profit booking decline from highs. But I believe buying interest could be there. Buy on decline could be the right strategy now. As of now, the support comes at 347, and with the support of 347, it can head towards 365, 370 zone.
Okay, that's the view on Indus Towers. Those are the levels to watch out for. Hope you've taken note of that. But let's shift focus to a query on transformers and rectifiers coming in from Shweta. She's bought the stock at 1100 and she wants to know why is the stock hitting lower circuit every day and whether she should add more, hold or sell. Her time horizon is 1 year, but of course the stock has been under severe selling pressure. But today it is witnessing a good bounce of 5%. How should she approach? 1100 is a buy price. Should she average out?
No, I won't suggest for average out. The stock has a different nature to trade. Trend is not clear in the counter. Already seen a corrective move. And our advice is that in this market, when many heavyweights and blue chip stocks are quoting at discount price from the higher levels, why to go for such name? So advice is try to exit position, you reduce on any small bounce in the counter.
Okay, that's about transformers and rectifiers then. Hope that answers your query. Let's move on to our next query then. Query on data patterns is coming up. Geetu Sandesh wants to know your thoughts on this particular stock. Uh, data patterns 2.5% up, but in tandem with some of the other defense names, you've seen data pattern also come off quite a bit. But let's not forget that the stock has seen a good rally. When the defense stocks were high flyers. How would you trade into something like a data patterns now? It's quite significantly. It has come out quite significantly off its 52-week highs. Any thoughts on how one should navigate this particular stock?
So looking at data pattern, it witnessed some profit booking decline on daily and weekly chart setup. In last 6 weeks, we have seen a corrective move from 2700 to 2050. Multiple supports are seen at lower zone, but follow-up is required. So getting the mixed cues, not in hurry to go for bargain buying. But yes, those who are looking to go for buying interest can follow the support near 2120 for a bounce till 2280 marks.
Okay, that's the view on data patterns. Hope that answers your query. Next one's coming in from Krishna, wants to know your thoughts on Triveni Turbine. He holds 100 shares at the rate of 720 rupees a piece and wants to know what he should be doing. Triveni Turbine 697 is where it's at. He's making a bit of a loss here. Your thoughts, because the stock has come under selling pressure. Over the last 1 month, it has shaved off 15%.
Yeah, so the short-term structure is weak and clear suggestion is try to exit the position. If it holds below 680, 675, it can see further decline with hurdle at 725.
Okay, that's about Triveni Turbine. Last query then, coming in from Puneet Rajiv Saxena wants to know your thoughts on LIC India. We've discussed some of those private insurers, but what about LIC? The stock has barely done anything in the last 5 sessions.
So we have seen a corrective move in LICI, corrected from 1222 to 800 zone in last 5 months. And now it seems that the bargain buy level is visible in the stock. However, short-term trend is in pressure, but I believe some recovery could be seen. With support of 820, one can look for a recovery towards 888 to 900 zone in LIC India.
Okay, that's about LIC India, and with that we've come to the end of the query segment. Chandan, as always, would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. Look forward to our next interaction as well.
Thank you so much.
Thank you. On that note, quickly take a look at the market before we get on board our next guest, big market voice. The Nifty is up almost 140 points. So yes, we are holding on to those opening gains at least until now. 23,350 back on the charts. Very good traction in the broad end of the markets. Third straight day of gains. We are building on the gains that we saw yesterday. Mid caps were outperforming yesterday as well, and today the outperformance continues. But on that note, the big market voice that I promised, Ajay Bagga, market expert, joining in. Mr. Bagga, it's always a pleasure chatting with you, and this is the first time I'm talking to you this year. So, first of all, a very, very happy New Year to you, and hope you make good profits this year.
Yeah, thank you very much. I wish you a very happy New Year as well, Nandita.
Thank you. Thanks a lot. Let's of course talk business now. Markets had a good start to the year, first 2-3 days, but then of course all the nervousness, jitteriness set in, and we saw steep correction. We've come off from November. In fact, we've broken below November lows as well. Lots happening on the global front. But if you look at the latest inflation data, would that come as a relief? How would you look at the Fed's trajectory now? Do you think Fed is still on track for 2 rate cuts, as was outlined by the central bank in the last meeting, or the last few data points that we have seen, could that throw a spanner in the works, and would you say that perhaps 1 rate cut or no rate cut at all?
Yeah, as of Friday, the markets were discounting 0 to 1 rate cut. But after yesterday's inflation data coming in a little softer than estimated, we are back to two rate cuts this year. The first rate cut probability has moved up from about October being the first rate cut to July as far as the Fed futures discounting goes. And there is about a 60% chance of a follow-up rate cut. Again, right now, what is working for the US markets? It's a very Goldilocks scenario where the economy is doing very well. There is no soft landing. In fact, there is no landing. It's soaring. The economy is growing at about 3%. So strong economy, slightly edging down inflation, which is very welcome. The Fed standing on the sidelines with the Fed put that in case anything goes wrong, we can cut rates. And fourth, corporate earnings coming in very strong. So we were expecting over these 2 days about $31 billion of profits to be declared by the major US banks. Yesterday, if you look at the earnings, JP Morgan came in with about 14 billion. Goldman Sachs doubled its profits to $4 billion year on year on trading revenue. So the Trump trade has worked very well for the markets. Now we are into the Trump inauguration trade. Now, with the Trump inauguration, there will be about 10, 15 executive orders coming in. Countries are worried about tariffs. Markets are worried about Trump tariffs, that they will be inflationary. So we have to wait and watch for that. But now, what has changed over the last 2 days and especially last night in the US markets, the big change has been that the Trump inauguration trade has come in. The Trump trade started from fifth night, sixth morning in the US, and we saw the markets going up. Then they gave up most of those gains over the last 10 days. Now, again, that trade is coming up on optimism. So you have a Goldilocks US, you have an Israel Hamas ceasefire agreement, which has a phase one, phase two, phase three baked in. And hopefully it will stay. Unlike the November 2023 agreement, which lasted for 1 week, hopefully this time around there will be an exchange of hostages and prisoners from both sides. And the ceasefire will hold and reconstruction will start in Gaza. That Middle East peace dividend is very critical for India because it will bring down the crude oil price and it could lead to further peace conference even with somebody like Iran, agreeing to more nuclear sanctions and more nuclear oversight. And it could turn out to be something very good in terms of a geopolitical dividend. So Goldilocks, geopolitical dividend, Trump inauguration trade. I would say those are the headlines for this week and the next.
Sure, of course, Goldilocks kind of situation in the US, but what about, in India, back home? Of course, tariff threat looming as Trump takes over in less than a week. We saw a lot of nervousness play out in the Indian markets as well, saw quite a lot of correction since last Monday. But, after all the correction, there's been some bit of a recovery or relief rally kicking in. I don't know how sustainable this is, but can you say with conviction that the worst of what's to come is already factored in, especially given the fact that Trump has already labeled India as the tariff king?
Yeah. Very difficult to say if the worst is through because see, Trump strategy is the Richard Nixon strategy of the madman strategy to take on the world. Richard Nixon, at the height of the Vietnam War, wanted to act very irrationally so that the North Vietnamese thought he could use the nuclear option. In the end, still, the communists in Vietnam triumphed over a superpower like the US. But Trump's strategy is similar. He acts very irrational, but that's more an opportunistic way to create more negotiating space. And now, if we had not started with 60% tariffs on China, now if it comes out to 10, 15%, which seems to be the higher probability, there will be a sigh of relief in the markets. If we had started with uncertain number, then getting to 5% also would have seen a big pushback from US corporates and the entire US supply chain. So this is the madman theory of international politics being practiced. So you can't really say what will happen next or if it will happen, but a lot of rhetoric will happen and a lot of volatility will happen. Lessons for India: just keep negotiating again, play the same game, and keep on answering him in his coin. As Canada today has said that we have identified $105 billion of US exports into Canada, and we will have countervailing tariffs put on those in case we are hit with tariffs of 25% next week on Trump assuming office. So you will have to keep on, there are no permanent friends. You will have to keep on putting the pressure back and reducing his negotiating space. So I'm sure we have excellent negotiators in the Indian Foreign Service who must be at it already, building up all the scenarios. As far as the markets go, we have a triple whammy. We have a slowing economy. We have tepid or muted earnings growth. And third, the fiscal impulses have slowed down because of the national elections. The expenditure didn't happen. And then the monetary policy stayed restrictive for too long. What that has created is that there is a reverse spiral where we are going down economically and companies are finding it tough to grow. The nominal growth rate of the GDP is down to about 9.7% as per the latest government figures of real growth for this year. Our calculation is the nominal GDP comes to 9.7. So a single digit nominal GDP is not good news. And then corporate earnings to grow 2-3%, 5% more than that becomes difficult when the macro is so challenged. So that's what we are facing. What is needed? It's needed. What we need is counter-cyclical fiscal policies, counter-cyclical monetary policy. Monetary policy, probably they waited too long, and hopefully in February they cut rates on the 7th of February. They would have had the budget mathematics by then. Budget, again, a big question of any tax relief or any more taxes on the markets. So I think that fear is very much there, and that will have to be borne out, and you will see volatility going into that.
Sure, Mr. Bagga, I think you've answered most of my questions, but I want to ask you, going by what you just said, 25 basis point rate cut, perhaps we can expect that, from the new governor. But, what do you do with banks now? Otherwise, we saw a CRR cut last policy. Do you expect another one, this policy as well in the upcoming one? And would that translate into margin improvement at all? Because fight for deposits may have eased a bit, but credit growth is slowing and MFI stress is a problem for some banks. So after the recent correction, what do you do with banks?
Yeah, you have to buy. I think the banks are sitting pretty, and you will get very good results from PSU banks. The few that have come out well. We are expecting a 16% year-on-year growth as a sector for PSU banks. They should do very well. So go and buy the banks. Even the big private sector banks, they are at very good valuations now, and a lot of the pain has been absorbed. What happens with banks? Pre-COVID, the CRR normalized was 3%. So RBI injected liquidity, but on the same side, it tried to make the banking system safer by increasing the CRR, and we had excess liquidity at those times. So that was there. Now you have drained out the liquidity. We are in a deficit of 2 to 3 lakh crores. VRRs are happening every day now. Today, 50,000 crores of VRR is expected. So RBI is having to inject liquidity into the markets. I think a CRR cut back to the normal level of 3% would be quite welcome, and it won't be inflationary. It won't lead to over liquidity in the system. It will barely make up the lack of liquidity. It would release about 1.8 lakhs to 2 lakh crores into the system, which is your deficit right now, even before going into the busy season fully, when February and March credit offtake takes off and you get very tight market condition, money market conditions. So a CRR cut would be good. If you look at around the world, ECB has been cutting well. The Fed cut and then held back, which roiled the markets. Bank of England was holding up, but yesterday their inflation number has come well, and they should be back into cutting. Indonesia, where the rupiah is down 8%, yesterday Indonesia went with a surprise rate cut, and they said because our growth is slowing down, we are taking the risk of a further fall in the currency, but we have to protect the growth. So Indonesia took a hard decision. Korea today wimped out. Korea, rather, they said they held up because the won has fallen nearly 10% versus the dollar. They held back, even though their economy is slowing down, their stock market is in some bit of trouble, and there is a political overhang. This would have been a good time to support the economy by cutting rates, but Korea has stood pat. So I don't know what will be RBI's thinking, but they must also keep in mind that whatever they do today, Nandita, will take 9 to 12 months to flow through into the economy. So they are late already, and whatever they do today will take 9 months to start making an impact. We should not slow down the momentum of this economy by an over tight policy for too long. That could have very serious consequences, and you will have to cut much more and inject much more monetary measures into the economy then to generate a revival.
What is your take on the Indian rupee trajectory? It has been, hitting record lows consistently. Do you think that gives any kind of room for the RBI to go for a rate cut?
See, Indian rupee, if you look at last year, we were down 2.9%. The dollar index was up 9%. So we have outperformed. We have to benchmark ourselves to the Chinese currency that was down 3.2%. And this year, the Chinese are holding. Yesterday, if you see, the PBOC put so much liquidity into their markets, short-term liquidity. They flush their markets with liquidity. The lunar year holidays are coming. They want customers and consumers to have funds in their hands. So we have to benchmark to China. So long as we are doing that, we are okay. If you look at last 1 year, we were down 2.9. China was down 3.2. Mexico was down about 4.5. Malaysia, Indonesia in the 4% range. The outliers were like Korea and South Africa, which were 10%. Even a yen was down 6%. Euro was down 7%. Pound is down 7%. So we are an outperforming currency. I get some euro remittances, and I was getting them at 91, 92 rupees, and I was shocked. Last week it came in at 88 rupees. So that's the outperformance you are doing. And as an export-dependent economy, we do need to protect those exporters. So RBI's mandate is more that we do a orderly depreciation of the rupee. We don't allow the rupee to appreciate too much. We have not had that problem so far, but even in short term, we make very orderly moves in the rupee. So 2.5%, 3% is quite valid and okay, and that's what RBI will aim for. I think there is no risk in cutting the rate because already the US is down to 4.25. You are sitting at 6.5. Easily we can come down to 6 and not have an issue, provided we control our inflation as well. But again, the inflation is more fiscal and more government supply chain policies on dals and edible oils, and then the crude oil due to the global factors, then due to your interest rate as such. So that traditional economic theory is not really working for the Indian inflation because food inflation is so high. Like when you have food inflation at 26% in some portions of the food basket year on year. What interest rates will you get in 50% rates? What will you do? It's better than to go for more optimized supply chains and more supplies rather than and government releasing from their buffers rather than trying to control that with a blunt instrument like an interest rate.
Sure, that's a very valid point you made, Mr. Bagga. I want to get in your thoughts on the insurance sector now. Even before they could get past the new surrender value norms, that is expected to, drain out or maybe impact margins. Now, this limitation on bank assurance strategy, that comes as another headwind. Do you expect growth to get stifled when it comes to the life insurance sector? How should one approach this space now?
Yeah, challenges are there, but it's a very underserved market. So it is a growth market. Unfortunately, the government policy has not been very conducive to the growth of the industry. The government and the regulator for insurance has their own reason. They are trying to ensure that there are no accidents. So that is there. Then also we have another overhang in terms of the GST on the premium. So that makes it quite more costly in a very underserved, underpenetrated market like India. So rather we should be subsidizing insurance. The government is now offering through the various Ayushman platforms. They are offering accident and health insurance. So maybe the bureaucrats have tick marked it that way, that anyways we have a 300 rupee product out there which is guaranteeing some returns to most of the population. But it's not that simple. If we have to really take this penetration to developed market numbers, you have to have a conducive regulatory framework. Secondly, you have to have a long-term regulatory framework where you're not making changes every year, because then business models become very difficult. How do you plan ahead then if you don't know how will you change on surrender values, how your solvency ratios might be calculated, what else you might have to put aside? Your business model planning then becomes very difficult. So large investors would find it difficult to operate in a market like this. So I would say it runs both ways. The government is also correct in making sure no private insurer has some accident. But I would say more the industry needs a very conducive regulatory regime right now. Let's get the penetration numbers up. Actually, the penetration to the GDP has been going down over the last 3 years because GDP has grown while the insurance has not grown in lockstep. So we need much more in depth. Of course, government will answer that they have brought in very low cost insurance for hawkers to the general public to senior citizens, everything. But that does not serve the purpose of really protecting the population, and especially the 100 million odd who are the real mass affluent, who are the earners in the economy. To protect them, it's not coming through.
Sure, Mr. Bagga. One last question really. Of course, just about less than 2 weeks to go for the budget. Of course, you mentioned that, any tax changes will be keenly watched out for. But would you expect capex to take priority, or would you say, given the fact that we have seen a growth slowing down, inflation as well, remaining stubborn, or would boosting consumption take priority, or do you think it would be a fine balance between the two? What are your own thoughts?
See, at 10 lakh crores, we were reaching our capacity of being able to absorb that much infrastructure spends. 11 lakh crores this year is not being spent. Last year also, we had a 50,000 crore surplus, which we could not spend. This year, we lost 4 months because of the national elections. And even after that, we have not seen orders really picking up. Railways has spent about 75%. They have done 2 lakh crores of allocations out, but rest of the sectors are still lagging. So I think we are reaching a capacity as an economy. Of course, the market will have a very tangential reaction. If you don't increase, they will say you were increasing at 30%, 20%. Now you're holding it flat. Not good news. So overall quality of expenditure is watched. But if you hold this line at 11 lakh crores, I think it's a very good number for an economy of our size. The second part is that where does the fiscal come in? So will you 4.9? I think we'll manage because we will underspend, not because of higher corporate revenues. Underspend and household taxes will help us. But will we come at 4.5% for the next year? That will be watched. Is the government's stated objective of reducing public debt? Are we moving towards that, or are we getting into a debt trap like the US? US last year paid $1.15 trillion as interest on its huge debt. So we should not get to that level. We are at 23-24% of our revenues are going towards servicing our debt. So we need to control that debt, control that fiscal, while increasing the quality of our spending. So the good thing for this government has been, like a typical bureaucrat's budget, we take money from various heads, rename it, and then launch it as a fresh initiative, while the overall subsidies have not really grown. So hopefully something like that will be done. What is not working, money will be taken out of there and it will be put into something more aspirational, more welfare. But capex, I don't think it will go more than 11 and a half or maybe 12. People are talking of 13, 13 and a half, but I doubt we have the capacity to spend so much in a year. I think we are reaching the level of our capacity. And 2-3 years, if we manage 11 lakh crores, that itself will be a huge booster into the GDP. The multiplier for infra spends is anything from 6 to 8 times. So it will add 50-60 lakh crores to the GDP over a 3-4 year period. So I think we should wait and let that come in and then increase the budget. But cosmetically, that number is very closely watched, as much as the primary deficit and the fiscal deficit number.
Sure. Got your point, Mr. Bagga. Thanks a lot. I'm afraid I have to call it a day here, but I would look forward to, another interaction ahead of the budget, and we'll make it specific to that, and perhaps we can have that someday. But would like to thank you for taking out time and joining in and putting things into perspective. It's always interesting chatting with you and looking at things from your perspective. Thank you. Thanks a lot.
Thank you very much for calling me. Despite me taking so much time, you keep calling me back. So thank you very much.
No, of course, it gives us a new perspective. Thank you.
Thank you. Take care.
Thank you. Well, on that note, quickly take a look at the market. Just a bit of a cool off, but nevertheless, we are holding on to that 23,300 mark, and the mid cap index also outperforming, 1.5% kind of gains coming in there. But in other important news, actor Saif Ali Khan has been injured during a scuffle with a thief who reportedly broke into his home. The incident, in fact, left the actor with multiple stab wounds, and he has been admitted to the Lilavati hospital for treatment. Now, reports are suggesting that Saif sustained several injuries during the altercation, and his condition is being closely monitored. Well then, on that note, we've come to the end of this edition of Opening Bell, leaving you with a triple-digit gain on the index. But of course, come back and join us for closing bell at 3:30 p.m. and later on in the evening, we also have a battery of experts to decode the Infosys quarterly numbers that will come out post market hours. So 4:15 around, that's the time when we will get on experts who will decode the numbers for us. So don't forget to tune in for that as well. But for now, thanks a lot for watching. Stay tuned to Money Control and have a great day.